Welcome back to Fast Market here on the Schwab Network. It's time for cash tags. For that, let's bring in Andy Swan. He's a co-founder at LikeFolio. Andy, welcome back to the show.
Thank you.
All right, so we're talking Netflix into earnings. You know, the stock almost hit those all-time highs that it hit a few years ago, about $700 a share. So it's had a great comeback over the last couple of years. But I mean, does your data reflect that, you know, the strength in the stock, where it's actually on a valuation basis, it's cheaper than historical norms, and you know, everybody's kind of piling into this one?
Yeah, I think it's cheaper than historical norms for good reason, because a lot of the growth, explosive growth in Netflix is behind it. We kind of see, you know, this is a great company, but it's at some point the law of large numbers starts to catch up with you. It becomes very hard to grow off of such a huge base, and I think that's where Netflix is today. You know, one of the things that's driven a lot of revenue growth for Netflix over the past, you know, 6 or 7 quarters has been the crackdown they had on password sharing. I think that boost is now pretty much behind the company. I think they've done a great job of cracking down on that and getting those shared passwords into new users and new revenue. You know, the other thing that I think Netflix has seen a lot of growth from is the ad tier that they have, where they're expected to do very significant numbers in terms of advertising revenue, and that is growing nicely, but also slowing down. And the one thing, you know, with Netflix, it's a little bit counterintuitive when you look at LikeFolio data in terms of web visits. When Netflix web visits are up, and they are year over year, generally speaking, that is not a good sign, because what people are going to Netflix.com to do is to cancel or likely downgrade their service. A lot of times, no news is good news for these subscription as a service businesses. Netflix is no exception. So we like to see that web visits be a little bit flatter. So going into this earnings report, I think you're going to see impressive numbers. You're going to see good growth. But I think there's some signals that growth is slowing, that the consumer base is slowing down, that competition from Peacock and others is starting to eat into customers' wallets, and people are starting to have to make some decisions on which tier of Netflix they want, and that's starting to become a little bit of a problem for Netflix. But no red flags. I just think you know, we're at a point in Netflix growth cycle where it's really hard to grow in a meaningful way. They're doing a pretty good job of it, but nothing to be excited about.
Andy, my gut feeling about Netflix and streaming in general seems to be backed up by your year-over-year change in visits chart that you put up, which shows it. You know, they're just the rest of streaming is just eating their own, right? They're fighting and they're merging and they're consolidating. They're doing all these things, but it seems like Netflix is going to be a clear winner. It seems like the advertising is a whole new growth for this thing. I think at the end of the day, it feels to me like it's going to be Netflix and it's going to be YouTube. And that's what your data kind of shows. So why shouldn't we be a little more excited if this is going to be the clear winner? And I think they're in the early stages of this ad-supported tier.
Yeah, I think the ad-supported tier is, you know, clearly they're a great avenue for growth for this company. They're at, you know, a little under $1 billion expected revenue in 2024. Hulu, on the other hand, is nearly $4 billion. So there's, you know, there's a company out there getting 4x what Netflix is right now. That shows you that there's significant room for growth. And like you said, Netflix, clear winner. It's the number one option. It's the one that people aren't going to get rid of. We just are starting to see a little bit of slowdown in the growth that Wall Street has come to expect. It's not, you know, it's not a raging fire inside of the factory or anything like that, but it's just they've come to a tough inflection point. They've cracked down on all the passwords they're going to crack down on. They've introduced the new ad tier, which is growing at a nice rate. Everything's going pretty well for Netflix. The stock price reflects that. And, you know, I think that's the modus operandi for the next couple of years, things are going to continue to go pretty well for Netflix.
They did say that paid net additions are expected to be lower in Q2.
Yeah.
International growth is still supposed to be their growth driver moving forward. But Andy, I wanted to ask you, are you guys seeing any data that's kind of reflective of live sports? Because I think that's becoming a big talking point as far as streamers go, trying to get as much live sports. They're going to start with the WWE Raw next year. They're doing a fight with Tyson later this month. But is that maybe a key for their next growth driver? Because that seems to be on the tip of everybody's tongue because all these advertisers are paying such big dough to be involved in live sports.
Yeah, live sports and live events, a little bit of an Achilles heel for Netflix. This is not a company whose technology was built to do that, and it shows. This is a company that's built to be on-demand streaming and did an extraordinarily good job of that. I mean, we can watch movies over our mobile connection because of the technology that Netflix has put out there. They're trying to get into live. I think there's been a few hiccups. It's a much different animal. I wouldn't be surprised to see Netflix do some sort of strategic acquisition to accelerate what they do in this space, because like you said, I think that's where the traditional advertising dollars are sticking pretty well in live, and especially live sports. And I think it's a huge avenue for growth, but it's also a monumental task to tackle, even for a company like Netflix. And so we'll see if they continue to try to build it out purely on their own, or if they go to a competitor that may not have the distribution they have, but has the technology and some of the deals in place that they could leverage better than that other company. I think that's probably the most likely scenario over the next 6 to 12 months.
Are you guys earnings score on this one, Andy, with the 4.5% pullback that we've seen so far this month? Would you guys be buyers here?
No, I'm not a buyer going into earnings. In fact, our score would have been bearish were it not for that, fairly significant pullback, excuse me. So I think the stock's priced about right. I think the risk is to the downside, like you guys talked about in the last segment, for a lot of these, mega cap tech companies, Netflix, no exception. But I would love to see this company move down 5-6%. On earnings, because I think long term it's just like Kevin said, it's the winner in this space.
All right, great stuff. As always, Andy, appreciate it.
Thank you.
All right, that's Andy Swan from LikeFolio, co-founder, breaking down the data for us. 4.5% pullback.